Good morning, everyone. Hope you're well. Hope you're doing alright. Welcome to the first episode of Ask Roy. In this series, guys, every day I'm going to be choosing one trading question and answering it in a YouTube video. You can feel free to ask me your questions in the YouTube comments down below, or whenever I launch a Q&A session on Instagram, you can go ahead and ask me your questions. I will choose one and answer it in a YouTube video. Today's question, which is a question that was presented to me through Instagram, through my Instagram Q&A session, which is how did I build a profitable strategy? I chose that question on purpose because I believe that everyone is interested in knowing how to build a profitable strategy, and I also believe that I have a lot to say about this specific topic. So let's start. Let's go ahead and start. First of all, guys, I believe that a trading strategy is divided into two different processes. The first process is a process that I call a directional process. So basically, a directional process is the process that helps you determine the direction of the markets, right? Which is simply, in other words, a bias strategy. All right? This is the first part. The second part is a participation process. So now I have determined the direction of the markets. However, I want to participate in that market in that direction. This is my participation process, which what you guys know as an entry setup. As simple as that as well. So a trading strategy is divided into those two different processes, a directional process and a participation process. Today, I want to talk about how to create a directional process, how to create a participation process, how to maximize the profits of a directional process, and how to maximize the profits of a participation process. All right, let's get right into it. So, my first tip to you guys is that I see a lot of people really focusing on their participation process. That's like everything traders focus on. They're like, okay, traders start by trading support and resistance. And then they're like, oh, fuck that, that's not working. Then they start trading trend lines. Then they're like, fuck that, that's not working. Then Fibonacci maybe. And then they're like, fuck that, that's not working. And then they go towards the SMC stuff, more order blocks for value gaps, all that shit. And therefore, we can see traders, what traders do is they are on a constant treasure hunt, looking for the right participation process to use that will finally turn them profitable. However, I want to tell you a story, guys. I want to tell you something that I have noticed a while from now, and maybe from it we can extract a lesson, basically. One day, guys, I was trading, as I normally would every day, and news were announced for the US dollar. News were negative. It was unemployment news, and the USA had really high unemployment. And therefore, I believe that the US dollar is going to melt down. So I sold the US dollar, and indeed, the US dollar started melting through to the downside. It was a good, profitable setup that I felt really good about. And then later on throughout the day, I was just doom scrolling on social media. I saw a guy filming a video. It was a green screen video. One of those green screen videos where you have the chart in the background and it's just his face on in the video. And he's talking about the trade, the amazing trade that he took today selling the US dollar. And it was almost the same exact trade that I took, except that he was using his own participation process, his own entry setup. So I have entered, let's say right here, right there. The market then went down. It came back to this area. This guy drew a support line right there, and he entered right here. As simple as that. And then as I was scrolling, I saw another guy who simply had a trend line drawn out through to the downside like this, who entered right there through to the downside. I realized then, guys, that everyone who was bearish on that specific day, everyone who was bearish after the bad unemployment news for the US dollar made money regardless of their participation process. And therefore, the participation process is not the top priority to reach profitability. It's important, and I will teach you how to maximize profits using your participation process. However, it's not as important as you guys believe. It's not the main thing when it comes to trading. It is not the top priority, because as I told you, on that specific day, everyone who was bearish on the US dollar made money regardless of their entry setup. If you were a support and resistance trader selling the US dollar, you made money that day. If you were a trendline trader selling the US dollar that day, you made money that day. If you were a fair value gap, order block, SMC trader, whatever, you made money that day selling the US dollar through to the downside. So what's more important, in my opinion, than the participation process is the directional process, which is what I'm going to start introducing to you guys. And again, as I said, a participation process is not something that we should totally ignore. I will teach you how to optimize it and how to maximize the profits of your participation process using two different methodologies that I will explain next. However, in my opinion, and what I've seen in the markets, I've been trading for 11 years, guys, and what I've seen, the directional process is the most important. I oftentimes see that if I have a certain directional analysis and I enter a trade, traders who use different entry setups also benefit from that movement. So if you are bearish and I am bearish and we both sell using different methodologies, we will both make money. So the problem is, what I see happening in the trading industry is that traders will get the direction of the market wrong. So for example, they will buy, let's say on that specific day where unemployment news were bad for the US, they will go ahead and buy. Let's say someone will buy right here. They'll be like, okay, this low has been taken out and it's pushing through to the upside. Market came back to a certain fair value gap. Let me buy, let's say. They will buy right here and they will lose that trade. And they will blame their participation process. They will blame the entry setup. They'll be like, oh fuck, this entry setup that I have learned is not working. Let me switch it ahead and go use another entry setup. So they give up their entry setup and go use a support and resistance. When, as you can see, the problem is not that you bought a fair value gap and instead you should have bought a support and resistance or Fibonacci or a trend line. No, the problem is that you were buying on a bearish day. That's it. However, most traders tend to blame their entry setup a lot more than they would blame their directional process. So first, I will speak about how to develop the most accurate directional process. Let's jump right into it. I'm receiving a lot of DMs, guys, from people sending me screenshots about accounts that resemble my username, that are DMing them and asking them, how's your trading going? If you invest $1,000, I'll turn it into $30,000 by the next 2 days, and therefore go ahead and invest. Listen, guys, those are all scams. It is not me, all right? I will never DM you first. The only way that you can apply for an opportunity to be one of my 5 students for the next classes is through the link in the description, guys. That's it. I will never DM you first. I'll never be like, hey, I'm creating an exception. You don't really have to apply through the link in the description. I'll just take you in immediately and you can shortcut the interview process and the selection process because I really like you. I really like the way that you're joking around with me on Instagram. I will never do that. All right. The only way you can apply is through the link in the description. That's it. All right. I'll talk to you guys soon. Let's resume the video. So, directional process. Let me get right into it. I will summarize my idea. I will not sugarcoat it, guys. Listen, guys, there's a lot of traders that go to higher time frames. They draw fair value gaps on the higher time frames, on the monthly or the weekly time frame, for example. And they're like, okay, this instrument is going to go there. Because of that fair value gap that wasn't mitigated, the market needs to go there. That is bullshit. Drawing lines on the monthly time frame or the weekly time frame and then determining the direction of the market because there's a fair value gap that exists there and you believe the market is going to go there, that is bullshit. And I know that you hate hearing this shit, but also you're unprofitable. You should hate the fact that you're unprofitable a lot more than what I'm saying right now. Listen, guys, oil, I need to tell you something. When instruments move on the charts, that affects global economies. And therefore, when you tell me a global economy, for example, Canada's whole economy is going to be affected as a result of a fair value gap that exists somewhere, that is bullshit, guys. It doesn't make sense. Listen to yourself. It doesn't make sense. So you go, for example, let's talk about oil, right? Oil prices. If I go to oil right now is around the $50 level. Let's say I draw a fair value gap around the $25 level. And I tell you, I believe that oil is going to go down to the $25 area because there is a fair value gap there. How the fuck does that make sense to you? How the fuck does me telling you that oil is going to drop 50%, fuel prices all around the world are going to drop, Canada, which is a major producer of oil, will lose billions of dollars just because there is a fair value gap around the $25 level? Guys, truly, when you listen to this, does this even make sense to you? Whenever I say this, there's some guy who's like, you don't know the power of fair value gaps. The algorithms always mitigate the fair value gaps. Countries will lose billions of dollars because there's a fair value gap? Really? You've been misinformed. You've been miseducated. And you know what the problem is, guys? Is that if oil actually drops to $25 and there happens to be a fair value gap there, there's some guy that is going to believe in fair value gaps even more. He's going to be like, oh, look, it all worked out. However, he won't look into the actual reasons as to why oil dropped there. Oil will not drop there because the fair value gap exists there. It might drop and the fair value gap happens to be there, but it doesn't mean that this is what caused it to go down. If a war erupts between two countries right now, let's say a war erupts between Iran and Israel tomorrow, oil prices will go up, regardless of the fact that there's a fair value gap at the $25 level. Oil prices will go up. If a war erupts right now in the world, gold prices, as we've seen for the past 2 years, will go up. Why is gold going up right now? Why is gold at $4,200? Because there's a fair value gap up there at the 5,000? Because there's a double top that needs to be liquidated? Gold is pushing up because we had Russia and Ukraine war, push up. Then we had Israel and Palestine war, push up. Then we had Israel and Iran war, push up. Now we have a government shutdown in the US, uncertainty, push up. And we have a trade war between US and China. That's why gold keeps pushing up. Not because there's some liquidity at the $5,000 that the market is trying to seek. Everything has logical reasoning, guys. And right now, if you go to gold and you go to a higher time frame and you're like, okay, there's a fair value gap around the $1,000 level for gold, and then a war erupts today, there's no way gold will go down. There's no way. It will push up in times of uncertainty, in times of instability. People rush and buy gold because they are afraid. And therefore gold prices, due to that huge demand for gold, it goes up, regardless of the technicals. Alright, guys, this is my advice to you. You can take it, you can leave it, you can believe in your Voodoo Mojo magic that is keeping you unprofitable, or you can simply study fundamentals, study macroeconomics. I will tell you from personal experience, guys, when I first started trading, I used to be a huge technical trader. All I'll rely on is technicals. That's it. That's when I first started. And then I learned macroeconomics, I learned microeconomics, I learned about interest rates, inflation, unemployment rates, retail sales, trade balance. I learned about Trump's tariffs and how they affect the markets. I learned about how wars and how certain events in history have affected the market before. So when they happen again, I can anticipate to a certain degree of accuracy how they're going to affect the markets again. And that, guys, increased my bias skills tremendously. It is very rare for me, guys, right now to look at an economy and misjudge it and be like, for example, this economy is bullish and this instrument is bullish, and then the instrument goes and actually becomes bearish. It's very rare for that to happen. All right, so really studying fundamentals, studying macroeconomics and microeconomics and using it as your directional process mechanism, it will increase your directional process accuracy tremendously. All right, that's all I'll say about this. Now let's talk about the entry process, the participation process, and how to maximize the profits that can come from that participation process. Guys, whenever I look at any participation process that anyone is using, I ask myself those two questions. And if you can answer those two questions very clearly, you will become profitable when it comes to your participation process. You will maximize your profits. So how do I do that? First of all, the first question is, what is the right stop loss and take profit technique that, if coupled with my entry strategy, will maximize its profits? Listen, guys, we see often there's traders, let's say the market is going down and they believe that the market is bearish. Their directional process, their macroeconomic analysis tells them, their fundamental analysis tells them that this market needs to go down. So they go ahead, for example, and they sell and they place, let's say, a stop loss that is right here. What ends up happening is the market retraces, hits their stop loss, and then starts moving through to the downside. And on the other hand, let's say their take profit is right here. So in that case, of course, the mistake that is happening right here is not that they guessed the direction of the market wrong. Obviously, the direction of the market is correct and they did a really good fundamental analysis. But the mistake that is happening right here is that they had a very tight stop loss, and that very tight stop loss prohibited them from the profits that they could have gotten. And therefore, the solution in that case is to have a somewhat larger stop loss. In other words, guys, there's a certain stop loss placement that would maximize the profits that your participation process can give you, right? That your entry setup can give you. If you have a very tight stop loss, you might miss out on these profits from trades that go in the opposite direction, trigger your stop loss, and then go in your direction. And therefore, if you choose the right stop loss technique, for example, if I'm like, okay, you know what, instead of placing it here, let me go ahead and place it right there. If I do that, then guess what? That trade ends up being profitable, and therefore I allow my participation process to give me the profits that I deserve because I got the direction of the market correct, or my fundamental analysis was correct in that case. So therefore, there's a right stop loss technique, there's a right stop loss mechanism that will maximize the profits off of every entry setup. And we can also take the other extreme. Some people, let's say you have a take profit that is right there. Obviously, depending on where you place your stop loss, your risk to reward ratio is going to get affected. If I place my stop loss, for example, right there, then that's obviously, it can be, for example, a 1 to 0.3, maybe the 0.0 something risk to reward ratio. If I place my stop loss as tight as this one right here, as this stop loss right there, maybe this will be a 1 to 3 risk to reward ratio. If I place my stop loss right here, then maybe this will be a 1 to 2 risk to reward ratio. If I place it up there, then maybe this will be a 1 to 1 risk to reward ratio. So obviously, as well, depending on my stop loss placement, I can guarantee either a higher risk to reward ratio or a lower risk to reward ratio, which will determine my profitability. So there's a certain balanced stop loss placement, which if you place your stop loss very tightly, then obviously you will be sacrificing a lot of profits. And if you place your stop loss in a very massive manner, also you will be sacrificing a lot of profits in terms of risk to reward ratio. So there's a certain balanced stop loss, which in that case is right here, that will guarantee you the most profits off of your participation setup. All right, as simple as that. Now, how do I find this accurate stop loss balanced area? It is by testing out multiple stop loss areas for my trading system. So what I can do is I can go ahead and I can be like, okay, should I place my stop loss here, or should I place it here, or should I place it there? Let's say I have this confusion right now. What I can do is I can go to the past, backtest 100 trades using this stop loss, then take the same 100 trades but using this stop loss, and take the same 100 trades using this stop loss. And I will then see which one guarantees me the highest PNL. And the one that guarantees me the highest PNL, I would know, okay, this stop loss, for example, gives me the highest PNL, which means this stop loss is the stop loss that would guarantee me the most profits, and therefore I would start using this stop loss. As simple as that. We can do the same thing for our take profit. Some people are afraid and therefore they close their trades very early, right? And therefore doing that, they sacrificed a lot of profits that they could have earned. Some other traders are very greedy and therefore they place their take profit very far away from wherever the price is at right now. And therefore what happens is the market goes in their direction for a while and then it comes back in the opposite direction and hits their stop loss. And with that, they would have sacrificed these profits right there that they could have gotten, but they didn't because their take profit is so far away. So there is a right take profit area, which is, let's say right here, a balanced take profit area that would guarantee you the most profits for your strategy. Again, how do you get that take profit area, how can you anticipate what it is? By simply taking multiple take profits area and testing it using your system. So you're like, okay, I will test those 3 different take profits area. I will take 100 trades with the first one, 100 trades, the same 100 trades with the second one, and then the same 100 trades with the third one, see which one gives me the highest PNL, and then that would be the take profit that would maximize my profits, and therefore that would be the take profit that I would start using. So this is question number 1. What is the right stop loss and take profit technique, not without placement, that I can use in order to maximize my profits? And as you can see, we just answered this question. And right now we have a participation process in which its stop loss and take profit are placed in a way that would maximize the profits off of that participation process, which is great. Now let's go to the second question. Now, the second question that I ask myself basically, which is a very interesting and very easy question, what are the market conditions that I should not be trading in? Listen guys, the majority of traders that seek profitability, let's define profitability. Profitability is simply when your wins are higher than your losses, right? Now, for majority of people right now, their wins are either equal to their losses, which means that they are break-even traders, or their wins are a lot less than their losses, which means that they are unprofitable traders. So what the majority of traders are trying to do is they are trying to increase their wins in order for their wins to basically become more than their losses, and finally they reach profitability. That is not the way that I think about it, because in order to increase your wins, what would you do? Right? Would you use another system with your system? You would add another entry setup to your entry setup that would add in additional trades that could be winners, and that's how you increase your wins. It's a very, it looks like unreasonable, right? Because then you would have to learn another strategy and then add it on top of your strategy in order to increase the amount of wins that you're taking. Or some people would just improvise and take additional trades, hoping that those additional trades would be wins, so they increase their wins and push their accounts into profitability. The way that I think about it, or the way that I handle this, is if I look at a participation process, or if I look at a strategy in which the wins are lower than the losses, what I'm trying to do is I'm trying to lower down the losses further. It is the same process. Instead of increasing my wins, so right now my wins are less than my losses. Instead of increasing my wins, I simply lower down my losses, and then my wins would be higher than my losses, and then I would be making more money and I would become profitable. So my goal is to minimize my losses. Now, how do I minimize my losses? I minimize my losses by taking all my losses together, grouping them, let's say in one folder, taking screenshots, studying these losses, and seeing the patterns that exist between my losses. And this way I would learn, and I will give you an example, guys, don't worry. This way I will see that there is losing patterns between my losses. So when certain patterns emerge, I tend to lose a lot more than I win. And therefore I start avoiding trading when those patterns emerge. This way avoiding a lot of my losses, and this way my wins would outshine my losses and I would be profitable. So as I said, the way that I would do this is I would group all my losses in one folder and look at the screenshots, look at these losses, and see the patterns that when they emerge usually cause me more losses than they would cause me wins. And then I would start avoiding trading when these patterns emerge, and therefore I'd minimize my losses and my wins would outshine my losses, and therefore I'd become profitable. So for example, I want to use USD CAD as an example. So USD CAD right here, we can see on 5 September, guys, there was really bad news for the US dollar. We had the unemployment rate at 4.3%, which is the highest unemployment rate in 4 years for the US. And here we have non-farm payrolls. Non-farm payrolls right there, 22,000 jobs added, as opposed to the 75,000 jobs that should have been added. Really bad news for the labor market in the US, as you guys can see here. And therefore the US dollar should have started going down as soon as those really bad news were announced. But as we can see here, the market went up a little bit. It targeted these highs. Look at this. It targeted these highs right there. And then USD started pushing through to the downside right there, which we could have sold right there. So guys, as you can see, a losing pattern in that case. So the first time I saw my participation process was right here. That was the first entry setup that I had on the chart. It happened somewhere inside right here on the lower time frames. However, a losing pattern that I avoid and that I have noticed in my losses is that when the market creates a cluster of highs right above my entry setup, it usually takes out this cluster of highs and then starts moving through to the downside. I noticed that losing pattern in my losses. So right now, I avoid taking a trade when the market has a cluster of highs right above my entry setup. By doing that, I simply avoid a losing condition. Right there. I avoid this losing pattern, a losing condition, and I minimize my losses by avoiding that trade right there. Thus, if I minimize my losses, as I said, my wins would outshine my losses and I'd be profitable. In that case, I waited for this losing pattern to disappear. Once it disappeared and the market took out these highs and started pushing down, then I looked for my participation process right here, took the trade right here through to the downside and benefited from that movement. There is an NZD JPY trade that I posted here on YouTube a few days back. You can go back, I believe 2 to 3 videos back, where it was very clear. I looked at it and I told you guys, usually I lose when there's highs above my trade, and therefore I will avoid that specific trade and I will take it next once those highs are taken. I waited for that losing pattern to disappear, and then once that losing pattern disappeared, I went ahead and I took the trade for NZD JPY. Let me go ahead and try to recall. Yeah, right there. I'm glad it's still drawn out. So right here for NZD JPY, the first trade that I saw was right there. The market pushed up, took out what these highs are, and then it started pushing down. And therefore, the first participation process, the first entry setup that I saw was right here. However, we can see right there that the market creates a cluster of highs with these highs up there. And therefore, I was like, I will avoid this participation process, this entry setup right here, wait for the market to target the highs, and then I would try to find another participation process through to the downside. Which, as you can see, the market then went down from there. It was all good. So by avoiding the first participation process right there, I avoided a loss that I would have otherwise taken. Now, how did I figure this out, guys? How did I know this? I looked at all my losses that I took previously, and I was like, what exists in common between my losses? And I saw that there's a lot of my losses where I would take a trade and there would be a cluster of highs above my trade and I would lose that trade and then the market would start moving in my direction. So I was like, okay, you know what? Those trades, I'm not going to take them anymore, because when that specific pattern emerges, which is highs just above my trade, when that specific pattern emerges, I tend to lose a lot more than I win. This is what I saw in my data. So I started avoiding it when it happens. As simple as that. So the first question is, what is the right stop loss and take profit technique that you can use to maximize the profits of your participation process? The second question is, what are the market conditions, the patterns that when they emerge, you should be avoiding? If you can answer those two questions very clearly, you maximize the profits of your participation process. All right. That's it. That's how I built my profitability. For me, as I said, my bias setup or my directional process is studying economies and determining the direction based on my studies, my macroeconomics and fundamentals. And then my participation process, I created one of my own. And then this is the way I optimized it. I asked myself these two questions and I maximized its profits by answering these two questions. That's it. I'll see you guys in the next video. I hope you guys enjoyed it.